Hello, everyone. Welcome back in. Today, I'm joined by Eric Prius, who is the Group Head of Investment Management at Envestnet PMC. Before I kick it over to Eric, I just want to share a little bit of communication that I want you guys to be aware of in terms of our last call. So, as you know, we held our call with BlackRock on the BlackRock Advisor Center last week, and a handful of you reached out to me and asked, "Hey, I don't see this in my InvestNet advisor portal. How can I see that?" If you don't see it in your InvestNet advisor portal, it will be here if you do have it enabled. If you don't have it enabled, you don't see it, you'll need to reach out to me. But once you have it enabled, you would hit this plus icon here. You can drag it up as high as you want, hit apply. And then once you have it added to your desktop on InvestNet, you'll need to just click into the BlackRock Launchpad, and then you'll need to attest to some disclosures. And then once you do that, you'll see all four widgets available there for you to dive into the tool. So there's the 360 Evaluator, Investment Quality, Scenario Tester, and Tax Evaluator. So again, if you don't see this and you want this enabled, please reach out to me, marcus.williams@stonex.com. Now, kicking it back over to Eric. Eric is, again, the Group Head of Investment for Envestnet PMC. As you all recall, back in November, we held a call with Michael Pescatore, just giving us a brief introduction to tax overlay. And Michael mostly covered the UMA tax overlay version. Today, Eric is going to give us a little bit deeper dive into the FSP management version of it, but also highlight some details of UMA tax overlay as well, and then tie that all together with direct indexing. If you all recall, we held a call with Scott Liddell from InvestNet PMC as well, and he covered the direct indexing overview. So with that said, I'll kick it over to Eric.
All right, thank you, Marcus, and thank you very much for having me on your call today. Hopefully everybody can see my screen. I'm just going to turn it into a slideshow mode. So many of you have probably heard the expression personalization at scale. And what I would submit to you is one of the most effective ways that you can apply a personalization to a client account is in the area of taxes. Taxes tend to be a very personal issue to investors, and being able to take into consideration a client's tax sensitivities or tax aversion is really important to an advisor's success. And this study demonstrates that. This is a study from a few years ago, but it's still very relevant today, that says that 92% of high net worth clients expect to get some type of tax planning advice. Yet only 25% of those clients believe they're actually receiving it from their advisor. So this means there's a disconnect between what the clients expect and what the advisors are delivering, but it also is a tremendous opportunity for advisors to broaden their value proposition to include some type of tax management. It also is easy to see that the heads of wealth management departments across the country are starting to recognize this need to apply tax management to client accounts. As you can see, a fairly steady increase in the percentage of heads of wealth management that are prioritizing tax minimization. And this is showing the similar data in a different way. It just shows that tax minimization is one of the most important investment objectives for high net worth clients, second only to wealth preservation. And I would make the argument that wealth preservation, or I should say tax minimization, is really just an extension of wealth preservation, because people do not want to lose their wealth by writing a check to the IRS. And let's illustrate why this is so important. If you think about taxable accounts, one of the biggest drags on the performance of taxable accounts is taxes. And this illustrates how damaging it can be. If you were to take just an initial investment of $500,000, invested over 20 years, And if you have just 1% tax drag, you're going to lose over $300,000 of your investment. And if you have 2% tax drag, it's over $665,000 that you lose over that 20-year period. Put another way, at 2% tax drag, you'll end up losing more than your initial investment to taxes. So it's critically important. Incidentally, the average mutual fund has over a 1% tax drag. So these are very realistic numbers. So what is the Envestnet solution to help you with this? There's two solutions, as Marcus alluded to in his opening comments. There's our overlay services and our fund strategist tax management. And I'm just going to briefly go through both of these services to help them come to life a little bit. The first one is our UMA overlay services. This is a holistic overlay service that's typically implemented with clients that want to have multiple equity SMA sleeves in their portfolios. And it enables the clients and advisors to customize around the needs of that end investor, typically around controlling taxable gains, but we also have a values overlay service that allows you to apply multiple tax screens in a client account, multiple values screens in a client account to help align the portfolio with the client's values. And it can be done while also providing that tax overlay that helps us eliminate short-term capital gains, diversify concentrated portfolios in a tax-efficient manner, and do it at client-specific long-term capital gains tax budgets. So how does it work? Essentially, the advisor, the financial advisor or the financial advisor firm determines the overall allocation of the account. In this case, you see an account that has multiple equity SMA sleeves. It has a fund strategist portfolio sleeve. These are managed models. The money manager communicates the model portfolio to Envestnet, and then Envestnet trades the entire account. And the client can benefit from having that coordinated trading that allows us to offset gains in one sleeve with losses in another and take a holistic approach at the client level. This slide just illustrates what that really means. We have a patented risk optimization engine that allows us to take client-specific customization requests, typically around taxes, optimize that portfolio so that the end portfolio has taken in those customizations, but from a risk standpoint, looks very much like the initial portfolio. There are some requirements for our UMA tax overlay services. This is taking advantage of the benefits of that equity SMA sleeve structure, as I mentioned. So we do require that at least 50% of the portfolio be allocated to managed product sleeves, either equity SMA sleeves or FSP sleeves. And we do bring that requirement down if there is a direct indexing sleeve in the portfolio. There's reasons for that I'll get into in just a second. For values overlay, we simply require 50% allocated to managed product sleeve and at least one equity SMA sleeve to take advantage of those screens. So let's get a little bit more specific around our tax overlay services offering. As I mentioned, it is designed to take advantage of that equity SMA sleeve, but we do have the ability to tax manage additional sleeve types like FSP sleeve types. So we put this slide together to make an important point that although we can tax manage a variety of different types of sleeves, there are certain types of sleeves that have a more effective tax management outcome for the end client. And so if you look at this slide, this kind of goes from best vehicle type to maybe not worst vehicle type, but from a tax efficiency standpoint, you go from most tax efficient to least tax efficient as you go down this grid. So although we can accommodate individual mutual fund and ETF sleeves, and we can accommodate FSP sleeves, you get much better suitability from a tax overlay standpoint with that index-based SMA sleeve. And that's because it has a large number of holdings. And if you think about what we're trying to do is we're trying to provide a client-specific tax efficient outcome, we benefit from a greater number of tax lots. Because as I mentioned in a second, we manage all of these accounts to the individual tax lot level, which gives us a lot of flexibility if we have more index-based equity SMA sleeves or active managed SMA sleeves. As I mentioned, this is supported by a patented risk optimization engine. It's intended to be a broad value proposition that can apply to virtually all of your taxable client accounts. We do allow for the incorporation of funds and ETFs really to help balance out an asset allocation, and it's supported by both a dedicated client service team that helps you analyze your client accounts when you're bringing them over to a tax overlay solution. We also have a dedicated trading team that trades these accounts. And these are some of the tools that we use when we are providing tax overlay. It's important to say that inherent in every tax decision that we make is our desire to have a tight adherence to the manager model. So we are always trying to keep a limited amount of tracking error to the overall UMA model, as well as each of the individual sleeve models. All of our trading is done at the tax lot level. We refer to that as versus purchase trading, or VSP trading. And we have a lot of tools in our arsenal because we are doing that. First of all, we are trying to eliminate short-term capital gains. So we may, if there's a manager that makes a model change, and that change results in a short-term capital gain for a particular investor account, we may choose not to make that sell. We may choose to wait until that short-term gain matures to a long-term gain. We may choose to wait if that trade is made or if that model change is made towards the end of the year. We might choose to defer it to the next calendar year so that it can be subject to the following year's tax budget. We also have a dynamic effort to match realized short-term capital gains against unrealized losses. Again, we're focused on the net gain exposure to the client. We are able to coordinate across all of the different sleeves. So if there is a small cap manager that makes a trade that results in a capital gain, we have the ability to look into the large cap sleeve or the international sleeve to try to offset that gain by taking a loss in one of those sleeves. We're also able to integrate outside capital gains into the portfolio. So if you have a high net worth client that perhaps is selling a business and has a meaningful capital gain in that business, you can communicate that to us, and we are able to get more aggressive in the loss harvesting in that account to help offset those external capital gains. We do try to have a zero short-term capital gains tax budget, as I mentioned, and we allow the clients to set their own long-term capital gains tax budgets. Of course, there's a trade-off when you are applying tax budgets to an account, and that comes in the form of risk or tracking error relative to the target portfolio. And we will provide a comprehensive illustration of that trade-off of tax realization versus tracking error in what we call our proposed asset transition summary. And I'll show you an example of that in a couple of slides forward. We do allow for funding these accounts with legacy securities, so you can fund them entirely with cash, but typically we see accounts that are moving from one advisor to another, and as a result they're funded with legacy positions, and very common to have legacy positions in equities, but we can also take in mutual funds and ETFs or even individual bonds. So let's talk about some of the key use cases for tax overlay services. First, there's strategic tax management. Think of that as just an overall effort to make the portfolio more tax efficient, typically with avoiding short-term capital gains. Those are the most damaging to an investor's after-tax return, but also managing it to client-specific tax budgets so that your client has certainty around what their tax bill is going to be come the following April. There's inevitable portfolio changes where this can be very valuable. For example, if you have a client that needs to start to de-risk, maybe they're 80% equities, 20% fixed income, and they need to get to 60-40, that can be a very tax challenging effort, especially when we have had so many years of a bull market, at least until recently. So having tax overlay on the account helps to mitigate the tax consequences of that de-risking. Advisor migration. If you are new to StoneX, for example, and have a book of business that you want to bring over, we can help bring that over in a very tax efficient way. I already mentioned the outside taxable events. But firm-wide manager changes. If there's an equity manager that's being removed from the platform for whatever reason, we're able to make a change to that manager and do that while adhering to client-specific tax budgets. And then finally, there's a lot of investors out there that have concentrated equity portfolios. We can help diversify them in a very tax-efficient manner by spreading the taxable consequences over multiple tax years. As I mentioned, we also can accommodate values overlay screens within our UMA tax overlay service. This can be provided at the same in the same account as tax overlay without an additional fee on it, and it's supported through our relationship with Sustainalytics. Sustainalytics is a leading provider of ESG and other ratings and research, and they are owned by Morningstar. And these are the various value screens that you can apply. You can see there's 23 different screens on a whole host of issues, and the idea is not necessarily to take a position on any of these screens, but to hear from your client on what's important to them and whether or not they want to convey their values through the portfolio management. These screens allow them to do that. So let's take a look at a hypothetical case study for our UMA tax overlay offering. This is a case of a high net worth client that's changing financial institutions. Got a fairly large portfolio of $11.6 million. With a cost basis of $8.9 million. And they want to go into a new diversified investment solution, but the client, as you can imagine, is very tax sensitive and is only willing to pay so much in taxes in order to move to this new portfolio. So our solution is to provide them with a proposed asset transition summary. And we illustrate a variety of things when we provide these summaries. The first thing we typically show is what would be the net realized short-term capital gains and long-term capital gains if they move to this new portfolio allocation without any tax management at all. And then we also will show on the other end of the spectrum what would be the tracking error. You can think of that as risk relative to the target model allocation. What would be the tracking error if we were able to move this without taking any short-term or long-term capital gains? And then we typically will show a couple examples in between those two extremes to give the advisor a sense of, well, how much can we save in taxes and what's the corresponding trade-off? Because as you can see from the chart on the left, there is a direct correlation between tracking error of an account when you're bringing an account over and the gains realization that you are willing to achieve, so are willing to take. The greater the amount of gains you're willing to take, the tighter the tracking error. And we illustrate this for the advisors so they can share it with the client. In this case, the client ended up choosing $500,000, a $500,000 long-term capital gains tax budget. Again, zero short-term capital gains. And then they were able to get the portfolio to a weighted average account level tracking error of about 1.8%. And then you can see we also measured the sleeve level tracking error for each of the individual equity SMA sleeves in this account. Then what we do is show them exactly what this means to their bottom line. So as you can see, the no tax management option, they would have had to take substantial short and long-term capital gains. They would have gotten very tight tracking error, but the first year tax bill would have been over $550,000. Very few high net worth investors are going to be willing to pay that kind of money to the IRS if they can avoid it. And so in this case, they chose this $500,000 long-term capital gains tax budget. They reduced their tracking error pretty significantly, and they reduced their first year tax bill from $550,000 down to $119,000. There is a fee for this service. In this case, it's $11,000. So the overall first year tax savings is over $400,000. Now, we're not saying you can eliminate taxes completely, but we can help you determine the timing and the type of capital gains exposure that you take, and allow you to spread these gains over multiple tax years in a way that meets the needs of that client. So that's our UMA tax overlay service offering. Let's talk a little bit more about our fund strategist tax management offering. In the former, the UMA tax overlay is offered in our UMA program, where there are multiple sleeves and typically, as I mentioned, multiple equity SMA sleeves. With fund strategist tax management, this is offered in the fund strategist program, where it's just one portfolio and it's invested in one FSP model. And we developed this capability several years ago, really because we noticed a disconnect as we were working with advisors that were trying to move more from an advisor as portfolio manager type business model to outsourcing it to third-party managers. And what we found was that about 80% of the accounts in our FSP program were in tax-deferred accounts. And yet in our APM program, it was much more close to 50-50. And so what this told us was that advisors were moving to models for their tax deferred accounts, but were facing tax headwinds to do it in their taxable accounts. And so we developed this service to address that and to make it easier to switch from either a brokerage account or a Rep as PM account to a fund strategist portfolio, and to do it in a very tax efficient way. And by automating and outsourcing this, clients can benefit from better after-tax outcomes. It also makes it easier to make portfolio allocation changes without fearing about the effect that that's going to have on the tax consequences of the client. We're providing that tax management throughout the year, not simply waiting till the end of the year. And it also allows advisors not to have to manage each individual client's taxes on their own, which can be a very manual and blunt process. So the benefits of it is it's intended to add value for virtually all taxable accounts in the FSP program. It's particularly effective in terms of easing the migration from advisor as portfolio manager or brokerage accounts to FSP models. It's very cost effective and it's flexible. It can be funded with individual equity securities, mutual funds, or ETFs, and it allows you to be able to sell those over multiple tax years, as I mentioned before. It does require cost basis for all of the existing holdings be given to us so that we can assess the tax consequences of moving from the current holdings to the new model. And it's all generated through a illustration that's within our proposal system. And I'll show you an example of that in just a minute. So this is what it looks like in the Envestnet platform. I'm going to show you a variety of screenshots here and then bring it to life with a couple of case examples. So within the proposal itself, there's what we call a portfolio overlay feature. We call it a POF that allows you to pick tax overlay service. So when you're building a proposal, the advisor simply selects this portfolio overlay feature if the account is eligible, and that tells us that this account will be tax managed. It also tells us direct it to our specialist trading team. Once they've done that, and once they've chosen the risk tolerance or the risk bucket for the individual client account, they can then choose the appropriate portfolio. Once they've done that, they have an opportunity to input the client's individual tax rates. And I might point out here that if they don't do that, if you skip this step, we will just default them to 20% long-term and 37% short-term. But it actually would be helpful to fill out this client-specific information. Many of the states out there have high tax states that can drive the short-term capital gains rate to 50% or even slightly more. So this does not change how we manage the account if these inputs are in there, but it does change the illustration that our proposal provides to show the tax consequences of migrating this portfolio. Okay, once they have loaded the current holdings and tax lot information, selected the portfolio, they then submit the account, and it goes to our risk optimization engine, and then it renders back within about 15 seconds or so a variety of illustrations. It will show you the current portfolio and what the tracking error is relative to the model that they want to invest in. And then it'll show 4 specific illustrations. One is what would be the estimated tax cost if there's no tax management applied. And then it'll show 3 tax sensitivity illustrations. What is the estimated tax cost and tax savings and tracking error at very high tax sensitivity, high tax sensitivity, and moderate tax sensitivity. And what you'll notice here is that there will be discernible differences in the tax cost between the very high, high, and moderate, as well as the corresponding tax savings and the corresponding tracking error. As I mentioned, one of the key differences between our Fund Strategist tax management service offering and the UMA tax overlay is that with the Fund Strategist tax management, we manage to client-specific tax sensitivity levels rather than a hard and fast tax budget. And so when we designed these sensitivity levels, we wanted there to be differentiation between these 3 sensitivity levels, as well as a differentiation between the moderate and no tax management at all. And what you'll see is in each case, you have meaningful differences. So the client has real choice as to how much tracking error do they want and what do they want their tax savings to be to move to this model. So once that illustration is made, then the advisor can choose a tax sensitivity for the client. Once they've chosen it, the proposal will render back what the initial trades would be if you submitted that proposal immediately for trading. And what you'll see here is that they do retain some of these legacy positions. So we don't trade immediately to model because we're retaining some of these legacy positions for tax purposes to keep that client's tax bill down. But we will trade enough to get as close as possible from a tracking error to that target model. So let's take a look at 2 cases of how this might come to life. And we wanted to show 2 cases, one where there's not a meaningful change in the asset allocation, and another one where there is a meaningful change, just to see how the solution can work in both contexts. So in this case, there's a portfolio that's not making a huge allocation change. The current portfolio is 87.5% equities, and it's moving to a 90% equity portfolio. But it is trying to diversify itself. So it's moving from individual stocks to a fund strategist portfolio model. In this case, it's a $213,000 portfolio, cost basis of $163,000, which means there's unrealized gains of $50,000. And so if you were to immediately move to the target model, given that you're in individual stocks now and will be moving to funds, you would have a potential tax bill of $8,700. Pretty meaningful tax bill. And so this is what the proposal would illustrate. It's got your current portfolio, about 5% tracking error relative to that model that you want to have. And if you don't apply any tax management at all, you're going to have that $8,700 tax bill. And then you have 3 choices, again, with meaningful differences in the amount of taxes that you will pay and meaningful differences in the tracking error that you will take on. And in this case, the client chose the high tax sensitivity level, reduced their tax bill by over $5,000 and got to a pretty tight tracking error relative to the target. So let's take a look at another example. This one is a portfolio where you need to de-risk. The client's 97% equity, but they really need to be in a 60-40 to have that portfolio match the risk class or risk tolerance of that investor. In this case, it's a $500,000 portfolio value with a cost basis of about $270,000. That means there's unrealized capital gains of about $230,000 that, if immediately realized, would have a $48,000 tax bill to the client. Now, I don't know about you, but not too many investors are willing to pay roughly 10% of their portfolio value to the IRS. So there's got to be a way to de-risk this portfolio and do it in a way that doesn't take quite as much of a bite out of the apple as this one does. And so here is another illustration. In this case, the current portfolio's tracking error is a bit higher, 9%. That's because it's 97% equities and it needs to go down to that 60-40 split. And if you don't apply any tax management, you'll have a $48,000 tax bill. And then again, the three illustrations of very high, and moderate sensitivity and the corresponding tax bills associated with each. Now, as I mentioned before, we're not saying we can eliminate taxes, and in this case, the client does need to de-risk, so there's going to be some type of tax consequence. But by choosing the very high tax sensitivity level, we got to a meaningful reduction in the tracking error, all the way down to 2% from 9%, and a meaningful reduction in the current year tax bill from $48,000 all the way down to $18,000. So in this case, the client chose the very high tax sensitivity level. And if that client wants to get closer to target over time, they could choose to do a strategy mod the following tax year and perhaps pick high tax sensitivity at that point, and the account will get a little bit closer to the target model by changing the tax sensitivity in future years. Now, I'll just finish by saying both our UMA tax overlay service offering and our FSP tax management service offering are supported with our after-tax reporting. This can be a very valuable tool to demonstrate to the advisor and to the end client the value of tax overlay. And I'll just mention a few key points on this slide. On the top right-hand corner, we calculate the actual pre-tax return of the account, the actual after-tax return on the account, and then the after-tax, the account's actual return lost to taxes. We then make the same calculations as it relates to the target allocation. What was the target allocation's pre-tax return? What was its after-tax return? And then what was the potential return lost to taxes? And the difference between those two numbers is essentially the after-tax benefit of applying a tax overlay service to the client. So you can put it in real terms that the clients will understand. Incidentally, we also illustrate what the cost of the service is and what the tax cost would be to remove the service. Sometimes our clients think more in terms of real dollars than they do in investment performance. And so in this case, they can see that, well, it's costing me $2,000 in fees to apply this service, but it's saving me over $19,000 in taxes if I were to eliminate the service. So it really helps that service come to life by providing the after-tax reporting to the end clients and demonstrating that after-tax benefit. So I'd like to thank you very much for taking the time to listen today, and I'm happy to open it up to any questions.
Thanks, Eric. This seems like a total game changer for our advisors to use with their clients. I just have a question for you. If you would sum it up in like your top 3 things of top benefits of using this service, what would you say those 3 things would be?
I would say, first of all, especially as it relates to the UMA tax overlay, it's clarity on your tax liability. By allowing for that hard and fast capital gains tax budget, that investor will know how much of a check they're going to need to have to write to the IRS the following calendar year. What high net worth investors hate is a negative surprise at tax time. That can really take a bite out of their financial planning. So that's one thing. The second thing is the elimination of short-term capital gains. Short-term capital gains can be extremely painful to the investors. So by eliminating those short-term capital gains, you're really helping the client out. And then finally, being able to gather assets from high net worth investors to be able to demonstrate to them that you can improve their portfolio They're obviously coming to you for a reason. They're not happy with their existing advisor, or they don't have an existing advisor, and you're able to improve that portfolio and provide the investor a robust illustration of how you can bring that over, improve the portfolio, and how you can do it while also minimizing the tax cost associated with it. So I would say those would be the three ones: the hard and fast budget, eliminating short-term capital gains, and migrating assets.
Perfect. Yeah, I think that's totally important as well. And just for all of you who are watching, I think this is something that you could implement into your practice, and your clients would just fall in love with the service, and even their CPAs as well. Some of your clients, or maybe your prospects, of walk into their CPA office and realize that they have these outstanding capital gains that they're being taxed on, and they have a tax bill that they didn't prepare for their upcoming tax year. So I think this will definitely help you guys in terms of practice management. And just a thing or two to add on here, this service for the UMA version of the tax overlay is typically around 10 bips. And the FSP version is maybe around 8. Another thing is, if you're running this for Pershing and Schwab Custodian, as of today, you guys can go ahead and start running those proposals and opening accounts for tax overlay. For StoneX Custodian, we are using this call as just another intro and say, hey, this is something that's coming soon to the firm. We'll keep you guys updated once it is widely available for StoneX Custodian. But in the meantime, what we've been doing here at the home office is partnering with advisors and say, hey, do you have a client or two where you want to see the benefit or value add for this service for a particular client? We can configure you into your InvestNet proposal system to run these proposals and have a conversation and see if this works well for your client. With that said, Eric, is there anything else that you want to add on top of that?
I would just add that we are here to help. So please reach out, and we've got a team of specialists that can help walk you through the service, and they can run a proposed asset transition summary for you on a specific client account to help it come to life for one of your actual clients. And then maybe just one clarifying point: our values overlay service is only available in the UMA program, where we're screening out individual securities with an equity SMA sleeve. So that's where it's available. And as I mentioned, if you have a tax overlay account and you add values overlay, it's not an additional fee. If it's only values overlay, there is a fee for that.
That's right.
But just wanted to make that clarifying point.
Thanks, Eric. Well, thank you guys. If you have any questions or are interested in running those proposals to see the value add of utilizing the service, feel free to reach out to me. Thanks.
Thank you all.